How's the economy doing? How's the market performing? Answers to these questions and more on this episode of Your Market Update. Hi, I'm Silas, the Principal Financial Advisor at Silas Parker and Associates, where we help you discover your happily ever after. To learn more about us or to schedule an introductory appointment, go to silasparker.com. Today, we welcome back Regional Director Roman Samuels from Russell Investments. Hi, Roman. Please help our clients and investors understand what's going on in the world today.
Well, short version is a lot happened last quarter and last year. So we're going to try and distill what happened down into a few core themes of what can we take away from last year, and how does the economy and the markets look this year? And going forward as investors, what are some of the things that we need to be aware of and trends that we need to be aware of and what might affect our portfolio? Let's get into it and start with the first place, which is just taking a quick snapshot at what happened last year. And so what you're going to see on this chart here is you're going to see three lines. You're going to see global stocks in orange. You're going to see US bonds in that dark blue line. Then you're going to see a 60-40 portfolio in light blue, 60% stocks, 40% bonds. This is the beginning of the year. This is the end of the year. Now, what you'll see here is there's a big dip that happens sort of in that March, April time frame. And if any of you are wondering what that might be related to, if the word tariff came to mind, you would be correct. This was Liberation Day, right around here. And then we saw a very sharp sell-off in stocks. You can see, however, bonds actually played the diversifier in the portfolio during that time. You can see bonds really didn't drop. Kind of floated over the gap, if you will, a little bit. But stocks dropped. Now, at that time, if you think back to that time in the news and in the headlines, and it was all very negative coverage of tariffs are going to be very destructive to global markets, to the economy. You're going to see inflation rise, all of these things. What did global stocks do after tariffs? Where did we end the year? You follow that orange line. Stocks gave you a 22% return last year. So stocks didn't really seem to care all that much about the potential negative effects of tariffs over these trade deals. What stocks told us is that everything looks pretty good, which is interesting because that's sort of not what we would have expected. In fact, if you see a lot of after the trade deals were announced, a lot of the stock markets of those countries rallied. After the Japan trade deal was announced, the Japanese stock market rallied. The Korean stock deal was announced. The Korean stock market rallied, so on and so forth. So this is showing us that the market's interpretation of what these trade deals and tariffs might be different to what clients might be feeling or what they might be hearing in the news. So that's a really important reminder. Markets tell us where's the capital flowing. That's what markets are telling us. They went into stocks last year. Now you look at a 60-40 portfolio, up 16% last year. That's incredible. Bonds gave you 7. So there was a lot of what I would call headlines that were sort of had a negative outlook on risk assets like stocks. That's not what we saw last year. So it's a really important reminder that things can happen differently than what all expectations are. Now, another really important takeaway from this chart is when your advisor, when Silas tells y'all to take advantage of a market drop and buy in to the market to actually increase your dollar cost averaging, maybe put some cash to work right now. It's a good idea. Even though there's tons of negativity and fear around that time, this is why we're saying that, because we see this happen all the time.
Taking territory.
Taking territory. Taking territory when the market's temporarily dislocated because of a temporary shock. Now, let's take a quick peek at markets a little bit more macro. So if we look at over the last 1 year, over the last 12 months, what did US stocks give you in return? 17.1%. Look at the returns that you've gotten from international stocks over the last year. Almost double what you got in US stocks, both from non-US and from emerging markets. Incredible, incredible returns from international. What's that takeaway here? Now, if you look over the last 3 years, US is still in the lead, but not by much. International's catching up. What does this tell us? This tells us that we want to make sure that when we're investing our assets, that we don't have exposure to just one country in our portfolio. Many self-directed investors, and Silas would agree with this, I'm sure, when we look at portfolios of clients who are running their own money, not using an advisor, most of the time what we see is that portfolio is in one market, the US. That's where it is. Now, you've made the most money in the US over the last, 3, 5, and 10 years. US has given you 14% per year for the last 10 years. It's been the best place to make returns. But it wasn't last year. It wasn't last year. And what we tend to see is every 10 years, we tend to see this capital cycle of one stock market dominating, and then that stock market doesn't dominate in the next decade. So the relationship between US and international is unbelievably cyclical, meaning in the last decade, you had US dominance. In this now decade, if history's a guide, we should start to see international dominance. And last year, we saw that. Question is, will it continue? Who knows?
We frame that for that individual investor who goes, oh, okay, I'm going to listen to that. Buy all US. Okay, hello, all international, right? What's the problem with that?
Yeah, the problem with that is that the US still is looking really, really strong. And we'll make a case for why the US is looking really good right now. So we want to own both. We don't want to have one or the other. That's not, in our opinion, the best approach. We want to own both. That is the approach. So we see many clients are just too concentrated in one region. Okay. So now if we take a look at one other very quick thing in 2025 returns, we talked about US, we talked about international. Take a look at municipal bonds. Municipal bonds are tax-free bonds. They are now outperforming cash. And this is powerful because everybody's feeling it in their high yield savings account at the bank. What's happening to the interest rate? It's coming down. It's coming down. And we've been talking about this for a while. That interest rates are going to be coming down. And as they come down, the party in cash is over. You're no longer going to get 4.5%, 5% from a cash instrument. You're going to need to now take some market risk and go into the market to get those types of returns now. Where can you get that same level of sort of cash return without a tremendous amount of market risk? Municipal bonds. And what's great about municipal bonds too is that it's tax-free at the federal level. Now, that you can't say the same of your cash and your CDs, which all generate taxable income, which you're going to pay taxes on this April 15th if you had any money sitting in CDs last year. So that's a great discussion to have with Silas about what should we do with our excess liquidity? Is there a more tax efficient way to generate return on that excess liquidity? So just something to be aware of there as well. Now let's take a quick peek.
Roman, real quick before we move on, for those investors who've been listening in and going, I hear you guys, but I was getting this and I just couldn't give it up. Is it now too late? Have they missed the boat on being able to make that shift into a municipal bond portfolio or have it part of their portfolio?
I think that the story that we have seen work very well with clients that have excess cash is you want to think about not as a cash replacement necessarily, but a cash complement. There absolutely probably deserves to be some part of your money that just stays in straight cash. What that is for each person is going to differ depending on your sort of sleep at night number,
Usually like an emergency fund, covering 3 to 6 months worth of all household expenses. But, they're usually keeping more than that in there because
They're
it's,
usually keeping more. Yeah, they're usually keeping more. So if we can kind of identify, okay, how much is that sleep at night number? What's left sitting in cash? That's a probably, is there another area that we can go to consistently get yield and interest that is tax-free at the federal level that tends to punch above what cash does over a long period of time? It's not always going to be the case, but over a long period of time, we tend to see that municipal bonds give you more return than just a straight cash savings account over time. So
especially
yeah,
a net return when you factor in the taxation and the fact that
absolutely. When you factor in the tax bill you pay on cash versus the tax bill you don't pay on munis, you actually are walking away with even more. So we refer to that as tax alpha at Russell Investments. So yeah, I think municipal bonds have tax alpha for that excess liquidity. So I wouldn't say you've missed the boat. This is more of a long-term approach to what is the standard of care for our liquidity and what are sort of the long-term principles that we want to think. So if you think your liquidity could maybe have some looking at, that's a great discussion to have with Silas about just, what are some options there. So it's something to point out. Now let's take a quick peek at the economy. In particular, let's look at inflation. And what we're looking at on this chart, if you haven't seen this chart before, is I call this the economic health check. You walk into the doctor's office, they scan your vitals. What are they looking for? Is everything in normal range? That's what they're looking for. So imagine the economy and the markets have gone into the doctor's office. They've gotten a scan. Here's the readout. The blue shaded region is the normal range, and the orange marker for each indicator is where is it right now. And as you scan this, I see a lot of things hanging out in normal range. Do we not? The only one is consumer sentiment, which is very, very low right now, but everything else is in normal range. Folks, that's a sign of a pretty health. That's good. That's what we want to see. Now, if we take a look at some of the numbers that always are in the news, inflation is 2.7 and dropping. Interesting because a year ago we had no tariffs. January of last year, there were zero tariffs enacted on, well, I shouldn't say there were zero tariffs, but the tariff situation was very different
that was
than
pre-Liberation Day.
pre-Liberation Day 12 months ago. Liberation Day hits April 2nd. Bunch of trade deals happen throughout the course of the year, and here we are in January of 2026. I believe we have collected, and Silas, keep me honest here, I don't know if you want to do a quick Google search, but 500 to 600 billion, I want to say, of tariff revenue we have collected so far in 2025. So we've generated, call it almost $500 billion of tariff revenue in the last 3 quarters, and inflation has gone down. I think that's a really important point to just pause and think about, okay, that wasn't what everyone was expecting. If you read all the economists' expectations, and the expectation was inflation would go probably above 3. And it did for a little bit last year. It did touch that 3.1%. So not to say it went straight down immediately. It did rise a little bit, but now it's come back down. So why might this be happening? Well, I think there's a lot of factors that go into this, but I think the thing to keep in your head if you're a client, you're trying to think through this, you want to think through 2 categories. There are inflationary forces in the economy, and then there are deflationary forces in the economy. There are things that create more inflation. There are things that create less inflation. Tariffs, inflationary. What are some of the deflationary things that we are seeing from tariffs? Well, the first is lower energy prices. I say this a lot on calls to clients. Oil touches every product or service in the economy, sometimes multiple times throughout the supply chain. If the cost of oil is lower, you are going to have less cost in the economy. Every other product gets cheaper if that is lower. And oil is very, very low right now. So that's a deflationary force that's sort of counteracting inflation that could be caused from some other field. I think another thing too is you think about the money, the 500 billion to 600 billion of tariff revenues that have come into the country. That's now currency that has entered the country that you haven't had to print at the central bank. And so we've printed a lot less currency in 2025, and printing currency is one of the primary ways you devalue the currency. And so when you don't have to print as much currency, but you still have the money supply coming into the country from other nations, now it's not an inflationary force. So there's a lot of forces that are happening there, but I think it's very interesting that inflation has sort of stayed pretty level and is actually kind of now trending down. Now, unemployment has risen a little bit. But again, let's think about that. If we look at last quarter, we had a big thing that caused a lot of noise in the data. One of it was the government shutdown. And the government shutdown, there's a lot of people who took the opportunity to take the severance pay and resign voluntarily. Those people are right now unemployed, getting their severance check or whatever. And the Treasury Secretary did an interview where he talked about the you're going to see those jobs reprivatize into the private sector. You're going to see the private sector pick up those jobs, and they will be now GDP sort of producing jobs versus taxpayer funded salaries. So what you're going to see, what he dubbed it was the reprivatization of the economy, is what he was talking about. What that means for unemployment is their expectations are you're going to see unemployment spike a little bit, and then you're probably going to see it drop over the next quarter or two. On GDP, 3.8% growth. I think the actual number was 4.3, but they revised it down because, again, of noise in the data from the government shutdown. So 4.3 was the nominal number that came out. That's incredible growth on a $37 trillion machine. So if GDP keeps growing like that, I think you'll see unemployment stay fairly unchanged. And if inflation stays fairly unchanged, you've got a really good looking economy from the three main indicators there. We want to see GDP growing, we want to see inflation low, and we want to see unemployment low. That right now, that's what we see.
And when it comes to consumer sentiment, generally, and this is, correct me if I'm wrong on this, Roman, we see the historical trend when consumer sentiment is at an all-time low, kind of how it showed up on the chart here. Those are generally really good opportunities followed in the market as far as performance. Conversely, when it's at an all-time high, that's when there's generally some type of market correction that follows shortly after. Anything you can speak on in regarding those?
Yeah, we've seen that data as well, which is basically that when you have periods of low consumer sentiment is sort of an index that tracks kind of what is people's sentiment about, the state of the economy, the state of the markets, things like that. And it's very low right now. You can see the scale only goes to 50 and it's at 51. All right. So it's low. Normal range is up here, right? So why is it so low? I think there's a couple things happening here. I think number one, there is, I think if you look at the coverage of the economic news, a lot of it has been negative over the last few quarters, particularly tariffs. When it comes to tariffs, that there's a very negative thing. It's an inflationary thing. And so I think tariffs are a very complex economic instrument, and they have far-reaching impact that I don't think everybody fully knows. So it's a very complicated subject, and so in the absence of that clarity, you probably feel a little bit less certain about the state of, is this good or bad or whatever. So I think that's a reason why I don't think the consumer has sort of figured out yet if tariffs are good or bad. They haven't really made a decision one way or the other yet. I think they're sort of kind of waiting to see if you see like which way the cards are going to fall still. So I think that sort of sentiment seems to be in there. But to what you mentioned, Silas, is that, well, that means that expectations are low. When expectations are low, that typically when expectations are low, the forward returns that we see in markets are very high, because once you get a few surprises to the upside, expectations readjust pretty quickly, money starts flowing, and prices reflect. So yeah, it could potentially be a buying opportunity to see the economy showing really sort of healthy signal and consumer sentiment being so low. That's a potential dislocation Who knows? So we'll see what happens. But yeah, there is absolutely that relationship we have seen be present. Now, let's take a look at something that is boosting international returns here. So, international, this is taking a look at the US dollar. And the dollar weakened over the last year. The dollar weakened relative to other currencies. And if you look at the US returns in the market, again, as we said at the beginning of this presentation, we had 17% returns in the US. And when we look at international returns were somewhere around 34% returns. So just way, way more return that you got from international stocks than US last year. But what we're saying is a big part of that, almost 8% of that outperformance came from currency. Let me explain what I mean. So the dollar gets cheaper, your international position in your portfolio outperforms by 14.5%. So your internationals went up in value more than your US went up in your portfolio last year. But then when you converted that return back into US dollars and denominated that return back into US dollars, you picked up more dollars because the dollar got cheaper. And so when you picked up more dollars, that boosted your return by an additional 8% last year. So currency was a huge factor in the role of internationals having such a phenomenal year relative to US stocks. The dollar got cheaper and that boosted your return. Now, the question is going to be, does the dollar keep getting cheaper from here? So if the dollar continues to drop, that's probably going to be a tailwind to international returns, similar to how it was in this last year. If the dollar strengthens from here, that'll probably be more of a headwind to international returns. So it's be interesting to see, but that's just something to be aware of. We typically, on average, the weakening cycles tend to be 4 to 6, sometimes 8 years. We've seen as the average weakening cycle. So are we in the beginning of a long weakening cycle? Who knows? I mean, you can kind of see historically where the dollar has sort of been. And so you can see we are kind of, I don't want to say we're overdue for a weakening cycle, but if we continue to see a weakening cycle in the currency, that's going to be a strong tailwind for international equities as long as that remains relevant. Also, sort of a side note, a weakening dollar tends to be very, very good for exports of the economy whose currency is weakening because your goods are now getting cheaper than everybody else's goods. And so if your exports go up, that's positive to GDP. And if you think about the reshoring of manufacturing that is occurring, the US is starting to kind of probably take on more of an exporting role in the global economy. It's probably a likely prediction. And so a weaker dollar tends to bode well for a economy that is starting to have exports become more of a part of GDP. Consumer spending is still 70 something percent of GDP. So we're still a consuming economy. But who knows? Maybe exports start to rise. The trade deficit has shrunk by the most, I think, in any single year. So maybe we enter a trade surplus relative to other nations, here pretty quickly.
Well, I'm going to tell you real quick. I'm going to check in my crystal ball real quick to see if it does know. Hold on one second. Oh, wait, I forgot to plug it in. Yeah, that thing doesn't work anyway.
Yeah, and mine doesn't work that much either. So, probably need a refund on those things. One of the things that's important to know about international versus US, I know I'm talking a lot about this trend, but it's an important trend to be aware of because it's a very interesting point or inflection point that we might find ourselves right now. So if you look at the net profit margin of US stocks relative to non-US, and this is going back over the last, call it 10 years here. So the average net profit margin of US companies is 15.9% profit margin. And right now, the average for US companies is at 23.4% net profit margin. So what does that mean? Well, the American stock market is trading up so much primarily because the Americans are making the most money. The profit margins have gone up, right? Substantially over the last decade. I mean, look at where they were a decade ago on average. They were below average, right? They were at, looks like 14% profit margins. They've gone from 14% profit margin on average to 23. That's a big jump. So the valuations reflect that. We're trading at 22 times earnings on average. Historically, we trade at 18 times earnings. So yes, the US is more expensive than any other stock market right now, but people who are bullish on the US are saying, yeah, but we've earned that, right? Because we have the highest profit margins. It's true. Meanwhile, international, their profit margins have come up. Their average is 13.5. They're trading at they're having 16.8% profit margins, and their valuations have come up slightly as well. But they are still trading very close to their 10-year average, meaning the upside versus downside potentially looks more attractive from a valuation perspective in internationals versus US. Now, one caveat is the US is ahead of at least it seems to be the case that the US is ahead of the rest of the world in AI and in the sort of the innovation that's happening there. And the current administration is sort of resetting global trade as we speak. So that probably is going to change the trajectory of US as well. So again, own both. We won't want to bet on own both. Own a meaningful amount of both. In terms of interest rates, here's what the Fed is the market is right now projecting that by the end of this year, we'll see the Fed funds rate at 2.9%. That's the market projection right now based on what the pricing is telling us. Now, if you get a new Fed chair, which it kind of looks like that's the way it might be going here, and that Fed chair is more dovish, in other words, more accommodative to the administration's sort of wishes, i.e., lowering interest rates faster. If you see the interest rates go down to 2.5 or 2%, I recently listened to an interview that the Commerce Secretary gave where he said that if you start to see that, you might see the U.S. economy hit 5, maybe even 6% GDP growth in 2026, which would be amazing, insane. I don't think we've seen a $37 trillion or $35 trillion economy grow at 6%. That's a very high growth rate. So let's see. Let's see what happens. But the market is telling us Fed funds right now is going to hover around 3. Now, I think this is a powerful illustration of the role that diversification is playing in your portfolio because there's a lot of uncertainty, isn't there? Rates could go down, rates could go up, stocks could go up, stocks could go down. How do we take all these potential variables and sort of restrain the potential outcomes so that we're not too far away from what we need to be compounding our money at to hit our goals? So this is what we're showing you here. This is stock returns on the top. This is interest rates on the left-hand side. And what we're looking at is a 60-40 portfolio. In other words, a 60% stock, 40% bond portfolio, which is what many of you listening to this are likely owning or some fashion of that type of allocation. Now, let's say stocks give me a 5% return this year. And let's say that simultaneously, interest rates go down by 0.5%. In finance jargon, we call that 50 basis points. So interest rates drop by 50 bips, stocks go up by 5%. If you have a 60-40 portfolio, your portfolio is gone up by 6%. Let me explain where that comes from. If you have a $100,000 stock portfolio, 60% stocks, 40% bonds, stocks go up by 5%. Interest rates fall by 50 basis points or 0.5%. Your stock, your $60,000 is going to grow by 5%, which is $3,000 of appreciation. And then your bonds, if interest rates go down by 0.5%, bonds move up as interest rates go down. And as interest rates rise, bonds fall. They have this inverse correlation to each other. So if interest rates go down, that's going to push bond prices up. So you get $1,700 of gains from the bond appreciation, but then bonds are also yielding you interest. So you get $1,700 of interest and you get $1,000 of the appreciation from rates falling. You add all that up and your total portfolio grew about $5,000, which is your 6%, 5,900. So what this is designed to do here is it's designed to show you that if I have stocks give me this return and bonds do this, this is how it affects the return of the portfolio. If stocks go down and interest rates go do this, you can kind of see where it goes. So it gives you a sense of understanding. Okay, so if stocks are down 10 and interest rates go up by a whole percent, meaning bonds fall as well, you're down 7 in a 60/40 portfolio. But if stocks rally 10 and interest rates fall by 100 basis points or 1%, you're up 10. So you're kind of within this range of, up 10, down 7 in potential outcomes, with sort of the more likely scenarios being kind of around here. Because if we get a 5% GDP growth, are stocks going to be down 5 or 10%? If we
No.
get 5, 6, probably not, right? And if inflation stays low, are we going to see the Fed increase interest rates? Probably not, right? So these variables, I don't want to say they couldn't happen, but they seem less likely given the economic backdrop that we're seeing right now. So you can kind of start to understand, okay, how you might be positioned and what asset allocation makes sense. Now, we've been hearing a lot about gold. Goodness, gold is coming up a lot for clients here. And as we start landing the plane on this presentation, I want to really, really touch on this slide here because I have seen this come up in conversations so much. Gold sort of went away for a while in conversations. Nobody really brought it up much. Why? Because gold wasn't returning anything. It wasn't giving you any return for a while. And then in the last year, gold has given you a 67% return. And so what is everybody talking about now? Should I own gold? So let's talk about gold and let's talk about why it's coming up. Well, gold has historically been viewed as a hedge to inflation. When you see high periods of inflation, gold is where you go. Well, let's take a look at that. So we're going to go back to 1975 here, and we're really looking at, okay, inflation from low to high and return from low to high. We're plotting all of the years. All of the gold returns in every year are in orange dots. And then we're plotting stocks in blue. So what I want to draw our attention to first is let's take a look at this half of the graph, which is your high inflation years. As you can see, 8% inflation, 10%, 12, 14, 16. These are your high inflation years. Let's take a look at 1980, which is a year when we had around 14% inflation. Gold gave me 13 during that 14% inflation year. So gold held up pretty well with inflation. Stocks gave me 33% over the same time frame. So stocks outperformed gold as an inflation hedge. Interesting. Now let's take a look at another year. Let's take a look at 1979. We have about 11% inflation during this year. Stocks give me 20% and gold gives me 140%. Wow. Okay, so gold really was a great diversifier there. What about 1975? 1975, we have a 9% inflation rate. Stocks give me 40% and gold gives me negative 30. Okay. And then we look at last year, 2025, where inflation was 3%, a low inflation year. And gold gave me 67% return. Okay, so what's going on here? What's the message? What am I trying to portray? Here's what I'm trying to portray. I don't see any meaningful correlation between high inflation and gold returns. If I did see that, here's what I would see. Every time we have high inflation, I would see all the gold years grouped around here where we have high returns. So if I was going to see correlation on this chart, what I should see is I should see whenever we're in high inflation, we have high returns in gold. That would show me correlation. That would show me a pattern. But when I look at this chart, I don't see any pattern. I see randomness. If I look at last year, 67% return, is there anything else that might have happened last year that could have caused that? Well, we did do record amounts of building out of one specific type of infrastructure. Data centers. Data centers, we had hundreds of billions of dollars go into buying data centers and building data centers last year. What are two commodities that you need a ton of to buy and build data centers? Gold and silver. What are the two precious metals that we saw have the most return last year? Gold and silver. So maybe it was a demand shock that occurred and had nothing to do with the devaluation of the currency or anything like that, the inflation trade. Maybe it was just sort of a demand shock that pushed gold up arbitrarily, and maybe that's not a repeat trick this year, right? Who knows? But what I do know about gold versus stocks, here's what I do know. Since 1975, gold has been positive 63% of the time, and it's given me a 6.4% return per year over the last 50 years. Stocks have been positive 82% of the time, and they have given me double the return over the same time frame. That's what I do know about the difference between gold and stocks. So that's why when you walk into your financial advisor's office and you ask them about gold and they don't ever seem all that thrilled about gold, that's why. Because they've seen this data, which tells them that you make more money in stocks, you make double your money in stocks, and their stocks are positive more often than gold is. And the gold returns seem to be completely random. There doesn't seem to be any sort of pattern that we can sort of anchor thinking on. So I'm not saying don't own gold. I'm just saying don't sell your stocks to buy gold. Keep your stocks.
That's where commodities within a portfolio, generally there's going to be a small sleeve in there just to make sure that there
Always.
is some participation in that. But again, you don't want
Yeah.
to throw your eggs in one basket.
Yeah, that's right. That's right. It's too random. If there was a pattern that we could see, okay, I'd give it to you, but I don't see that. This is just a quick, I call this the engine check dashboard. In your car, you turn your car on. You don't want to see any yellows popping up or reds on your check engine dash light. So here you look at the Europe and the UK, they've got a few yellows. They got Purchasing Managers Index, and you look at Asia Pacific, sort of same thing. But you look at the US, I don't see any yellows in the US. Everything looks pretty good.
Systems go.
All systems go. So looks good to me. Um, let's sort of end here. We got this chart and one final chart that we'll end here with. And I just want to touch on taxes really quickly because we're about to enter tax season. And it's good to just take a moment to look at what happened last year from the tax standpoint. So stocks went up 17% last year in the US. Now, regardless of your investment return, 75% of all mutual funds paid out a capital gain distribution to clients last year. And you'll be getting those 1099s in the mail in February of this quarter. And the average capital gain distribution was 8%. Now you'll notice there's a big chunk that didn't pay any capital gain distributions. It's not a huge chunk, it's about 25% of the funds out there. The question you need to be asking yourself is, are you getting this return with no capital gains, no tax bill? Or are you getting a return and then getting a tax bill from the IRS or from your mutual fund company to pay the IRS? That's the question, because if you are, there are investors out there who aren't getting that. There are investors out there that are investing in the same market as you, in the same stocks as you, in the same areas as you. You're getting a tax bill and they're not. What's the difference? Well, some investors are invested in tax managed portfolios. If you're with Silas, you are invested in tax managed portfolios that have no capital gain distributions. Hint, hint, they're made by Russell Investments.
That's where tax
Okay.
loss harvesting comes in.
Right. So as you get a 1099 next month in February, as you get a 1099, I want you to look at line item 2A on that 1099. And if you have capital gains sitting there, That's going to be a good thing to raise your hand and go chat with Silas and see how you can maybe make sure that doesn't happen next year and the year after that and the year after that and the year after that. Okay. So just be aware of taxes. They were a big cost last year, but there's investors out there that aren't paying that. Let's land the plane. Let's take a look at a lot of clients who say to me, you know what? I feel like the AI bubble's about to burst. I'm just worried about the market. I think the AI bubble's about to burst. Well, let's say you put $100,000 into the market at the very beginning of the dot-com bubble bursting, not after the bubble burst, before the bubble burst. You put $100,000 into the market right at the peak of the dot-com. You put 100K into the market right at the peak of '08, right before the '08 bubble, and you put 100K right in before the peak of the COVID bubble. Where would you be today? If you had invested 100K at the beginning of the dot-com bubble, after you ride the ride down, and you would have multiplied your money by 700% return. That's investing before the bubble burst, riding it all the way down and enjoying the upside. You'd be up 7 times on your money. If you'd done that in '08, you'd be up 6 times on your money. If you'd done it in COVID, you would have doubled your money by now. What is the lesson here? The lesson here is that the prevailing narrative is that if I put my money into the market and the market drops immediately the next day, I put it in right at the top of the bubble bursting, that I have destroyed my future forever, that I have just taken all my life savings and I've dumped it all into a gambling slot machine and I've lost all my money. That's the prevailing narrative. And so there's this sort of fear that I have to get in at the right time. We're showing you the last 3 instances where you got in at the absolute worst time to get in. You just had the worst luck of any investor, and 3 times in a row, you just nailed the top of the market. You just put your money into work right before it burst. But if you had stayed invested, had let the market recover, given it time, look at where you'd be. Here's how you win the game of investing. It's not by timing the market. It's by time in the market. That's how you win the game of investing. You have to put your money to work and don't care about the day you're putting it to work. Don't care if it's potentially the top of the market. Don't care. Put your money to work in an asset allocation that makes sense for your risk profile and stay invested through the volatility. That's how you win the game of investing. With that, Silas, I will hand it back to you, my friend.
Roman, thank you so much. Before we proceed, just a quick announcement from our compliance teams. Thanks for everybody for tuning in to watch this episode of Your Market Update. Go to silasparker.com to schedule a review of your portfolio. We look forward to seeing you next time. Till then, take care.